Welcome to today's Explainer. Look, I want to kick things off by asking you a really serious, maybe even slightly uncomfortable question. Are your traditional bank savings actually making you poorer? I know, we've all been taught that tucking our money away in a bank is the absolute safest path to financial security. But today, we're going to look at the hard data, demystify the share market, and figure out if that old school advice is actually just a trap. This right here is what we call the silent wealth killer. It's the gap between your returns and real-world inflation. Think about it. A standard savings account gives you, what, maybe 3 to 4%? A fixed deposit might give you 6 to 7% if you're lucky. But real inflation, the actual rising cost of living, that can hit 12 to 14%. When inflation drastically outpaces what the bank pays you, your money isn't growing. It's actually actively shrinking. So, here's our roadmap for today's Explainer. We're going step by step. First, the middle-class wealth trap. Second, decoding share market risk. Third, the micro-investing blueprint. Fourth, day versus delivery trading. Fifth, market mechanics. And finally, number 6, India's investing revolution. Let's dive right into Section 1, the middle-class wealth trap. The old playbook has officially failed. Here's exactly why those traditional methods are basically a trap now. Not only do fixed deposits yield a mere 6 to 7%, but you also have to remember the tax man. A chunk of that return is taken away by taxes, sometimes up to 30%. Throw in that 12 to 14% inflation we just talked about, and you are literally moving backwards. And what about gold? Well, prices are at all-time highs, sure, but there are very real safety risks with keeping or wearing physical gold. Honestly, it's becoming just a shiny object stuck in a bank locker rather than a practical, everyday investment. Moving on to Section 2, decoding share market risk. Okay, let's address the elephant in the room. People are absolutely terrified of the share market because, yes, investing means you can lose money if a company fails. But I want you to really absorb this quote. When there is no risk, there is always a more risk. Refusing to take any calculated risk is actually the absolute greatest financial hazard of all. Why? Because you are guaranteeing that inflation will eat your wealth. Now, to put that abstract idea into perspective, look at the sheer scale of what calculated risk can actually do. These numbers are mind-blowing. If you had invested 1 lakh rupees into MRF back in 2001 when it was just 700 rupees a share, by 2024, that would be worth an incredible 1.8 crore rupees. What about a 1 lakh investment in Wipro back in 1993? That would have snowballed into an astonishing 4.63 crore rupees. So yes, the share market carries risk, but it's also the ultimate engine of historical wealth generation. That brings us to Section 3, the micro-investing blueprint. Start small, grow big. You don't need a massive salary to do this. Enter the micro-habit strategy. Step 1 is so simple. Save just 100 rupees every month. That is literally less than what many people blow on small, bad habits like buying pawn, tobacco, or random snacks. Step 2, just increase that tiny investment amount by 15% every year as your income naturally grows. And Step 3, just sit back and let compounding work its magic. And here is the wow moment, 1 crore rupees. If the market averages a 15% return, which, by the way, is historically realistic, this super simple 100 rupee consistency strategy will snowball into 1 crore rupees over 25 years. You don't need a fortune to start, you just need relentless consistency. And getting started is easier than it's ever been. To get past the administrative stuff, you literally just need an Aadhaar card, a PAN card, a regular bank account, and a Demat account. Today, the friction is basically zero. There is 0 brokerage apps out there, like Shunya, for example, that don't charge you a fee for every single transaction, and they even offer AI prediction tools to help guide your decisions. Section 4, day versus delivery trading. Choose your strategy carefully. Now, a quick word of caution before we go further. You need a Demat account to hold shares. But in Hindi, the phrase Demat playfully sounds like don't give. And honestly, you should treat that as a built-in warning. Don't go giving your hard-earned money blindly to get-rich-quick schemers on YouTube or Instagram who promise to double your money in a day. A Demat account is for patient, long-term investing. Which brings us to a really vital comparison. Look, day trading is chaotic. It's driven by rumors, it's incredibly stressful, and if the market dips, you have 0 time to recover before the trading day ends. Delivery trading, on the flip side, is where you buy a stock and hold it patiently, exactly like you would real estate or gold. If the market drops, no big deal, you have the time to wait for it to recover. Delivery trading is how you aim for those steady, realistic 15 to 20% annual returns without totally losing your mind. All right, Section 5, Market Mechanics. What actually moves prices? Markets are not magic, guys. They react to real-world data. So here are 5 core reasons the markets fall. 1. A weak or unstable economy. 2. Negative daily news, like a sudden tax hike. 3. Rising inflation, because that lowers consumer demand. 4. High crude oil prices, which push up production costs for companies. And 5. Globalization. Basically, if the American market stumbles, it directly drags down domestic Indian tech giants like Infosys and Wipro because they do so much business over there. Now let's look at the flip side. Here are 5 reasons stocks rise. 1. Big corporate orders, like when Siemens secured a massive 150 crore deal back in 2005. 2. Massive sales growth, which historically spiked Tata and Bajaj stocks. 3. Major joint ventures, like SR Global partnering up in steel. 4. Big acquisitions, like Kodrich expanding globally. And 5. This one's actually fascinating. Monsoons. A good, clear season after the rains dramatically boosts construction, which directly drives up demand and stock prices for cement companies. See? It's like a giant puzzle, but it's incredibly logical when you break it down. And finally, Section 6, India's investing revolution. Everyday people are finally waking up to the reality of wealth generation. Just look at this. Between 2019 and 2023, the National Stock Exchange saw 120 million new investors register. That is 12 crore people entering the market. And in just one single month, January 2024, another 5.4 million new registrations poured in. The middle class is realizing that traditional savings are a trap, and the idea is spreading like wildfire. They are moving their money into the future. Which brings us to the ultimate question for you to ponder today. The blueprint is right there. The tools are absolutely free. The math of compounding is completely proven. So, what's it going to be? Will you take the first step today to protect your money from inflation, start your simple 100 rupee habit, and own a piece of the future? Or will you let that silent wealth killer keep shrinking your potential? The choice is entirely yours. Thanks so much for joining me on this explainer. Keep learning, and I'll catch you next time.